A sudden financial tremor has rippled across global markets, with its epicenter in Tokyo. This unexpected shift has captured the attention of economists and investors worldwide, prompting urgent analysis and speculation. Before we delve into the details, thank you for the overwhelming response to our previous video. Your engagement and insights have been invaluable. Today, we set the stage for a deeper exploration of the explosive economic data that has emerged. Understanding these developments is crucial for grasping the broader implications for international finance. Let's examine what triggered this shock and what it could mean for the future of the global economy. In December, the Bank of Japan surprised financial markets by signaling a potential interest rate hike, a move that diverges from its long-standing ultra-loose monetary policy. Historically, Japan has been an outlier among major central banks, maintaining negative interest rates even as others tightened policy to combat inflation. This cautious approach was rooted in decades of low growth and persistent deflation. The recent shift suggests that Japan may be preparing to join the global trend of monetary tightening. Analysts are closely watching for further indications, as any rate adjustment could have significant implications for both domestic and international markets. The bank's announcement marks a notable departure from its previous stance and raises questions about the future direction of its economic strategy. Governor Kazuo Ueda's recent remarks have drawn significant attention from financial markets. Shortly after his comments, Japanese government bond yields experienced a sharp increase, with both the 2-year and 10-year yields surging noticeably. The 2-year yield, often seen as a gauge of short-term monetary policy expectations, climbed to levels not seen in years. Meanwhile, the 10-year yield, a benchmark for long-term borrowing costs, also rose substantially. This immediate reaction underscores the market's sensitivity to signals about future policy direction. Such movements in yields can have broad implications, affecting everything from government financing costs to investor sentiment. The pronounced jumps in these key maturities highlight the significance of Governor Ueda's statements for both domestic and global financial landscapes. Recent developments have triggered a rapid spillover effect across global bond markets. Yields have climbed noticeably in both Europe and the United States, reflecting heightened investor uncertainty and shifting risk assessments. This surge in yields is closely tied to changing expectations about future monetary policy, particularly regarding potential U.S. interest rate cuts. While earlier forecasts anticipated rate reductions as soon as 2026, the current market sentiment suggests a more cautious outlook. Investors are now recalibrating their strategies, factoring in the possibility of delayed easing by the Federal Reserve. These adjustments are influencing bond prices and yield curves worldwide, underscoring the interconnected nature of global financial markets. Japanese government bond yields play a significant role in global financial markets due to the investment behavior of Japanese investors. For years, these investors have been among the largest buyers of foreign government bonds, seeking higher returns abroad when domestic yields are low. As Japanese yields rise, the incentive to invest overseas diminishes, prompting a potential shift of capital back to Japan. This process, known as capital repatriation, can have far-reaching effects, including increased volatility in international bond markets and changes in global interest rates. The decisions of Japanese investors, therefore, influence not only their domestic economy, but also the broader landscape of global finance. If Japanese investors begin to reduce their purchases of Western debt or choose to repatriate funds, the impact on Western debt markets could be significant. These investors have historically been major buyers of government bonds, helping to keep borrowing costs low. A withdrawal of Japanese capital may lead to higher yields, as Western governments would need to offer more attractive terms to entice other buyers. This effect could be amplified in periods of increased government borrowing, when the demand for funding is already elevated. Higher yields can translate into greater debt servicing costs for governments, potentially straining public finances. Additionally, market volatility may increase as investors adjust to the changing landscape. The overall stability of Western debt markets could be challenged, especially if alternative sources of investment do not materialize quickly. The butterfly effect describes how small actions can lead to significant consequences across the globe. In this instance, a single hawkish signal from Tokyo sent ripples through international financial markets. Investors reacted swiftly, tightening global financial conditions as they reassessed risks and opportunities. This shift in sentiment did not remain confined to Asia. It influenced expectations for U.S. monetary policy as well. Market participants began to anticipate a more cautious approach from the Federal Reserve, reflecting heightened uncertainty. Such interconnectedness highlights the sensitivity of financial systems to policy signals, even those originating far from Wall Street. The episode underscores how decisions in one region can reshape economic outlooks worldwide. Recent developments have led to a significant change in the outlook for U.S. futures markets. Investors are now less optimistic about the possibility of aggressive interest rate cuts by the Federal Reserve. This shift has resulted in a more cautious market sentiment, with traders adjusting their positions in anticipation of a slower pace of monetary easing. As a result, volatility has increased, and asset prices are reflecting the uncertainty surrounding future policy decisions. The diminished expectations for rate cuts are influencing both short-term and long-term investment strategies across various sectors. After a prolonged period of weakness, the Japanese yen has experienced a dramatic surge, catching the attention of currency markets worldwide. This sudden shift has significant implications, not only for traders, but also for global trade dynamics. A stronger yen can make Japanese exports more expensive, potentially impacting the competitiveness of the country's goods abroad. At the same time, imports become cheaper for Japanese consumers and businesses. The volatility in the yen's value may prompt central banks and policymakers to reassess their strategies, as fluctuations in major currencies often ripple through international markets. Investors are closely monitoring these developments, seeking to understand how the yen's movement might influence broader economic trends. Equity markets have experienced a notable downturn, with technology stocks on Wall Street driving the pullback. Shares of major tech companies, often seen as market leaders, have faced increased selling pressure. As a result, both the Nasdaq and the S&P 500 indices have slipped into negative territory. This decline reflects broader investor concerns and a shift in sentiment, impacting not only the tech sector, but the overall market performance. The movement underscores the volatility that can arise when influential sectors experience rapid changes. Recently, Bitcoin has experienced a sharp decline, reflecting heightened volatility in the cryptocurrency market. This downturn has coincided with a growing correlation between crypto assets and high-growth equities. As investors seek returns in riskier sectors, movements in technology stocks and digital currencies have become increasingly synchronized. This trend suggests that macroeconomic factors, such as interest rate changes and market sentiment, are influencing both asset classes. The convergence highlights how cryptocurrencies are behaving more like traditional financial instruments, rather than remaining isolated from broader market dynamics. Recent developments in the U.S. economy have led to increased speculation about a possible Federal Reserve rate cut in December. Market participants are closely monitoring inflation data, employment figures, and signals from Fed officials, all of which suggest that monetary policy could soon shift. Futures markets now reflect a higher probability of a rate reduction, with investors adjusting their portfolios in anticipation. This growing expectation has influenced bond yields and equity prices as traders seek to position themselves ahead of any policy change. The potential rate cut is seen as a response to slowing economic growth and persistent uncertainties, aiming to support financial stability. As December approaches, the market's pricing will continue to evolve based on new economic indicators and Fed communications. The future direction of U.S. monetary policy remains uncertain, with analysts and investors closely watching for signals from the Federal Reserve. Speculation is mounting over who will be appointed as the next Fed chair, a decision that could significantly influence the central bank's approach to interest rates and inflation. This uncertainty has led to fluctuating market expectations as participants try to anticipate whether policy will remain accommodative or shift toward tightening. The choice of Fed leadership is seen as pivotal, not only for the U.S. economy, but also for global financial markets. As a result, investors are adjusting their strategies in response to potential changes in monetary policy, highlighting the far-reaching impact of central bank decisions. The U.S. dollar has recently experienced notable weakness in global markets. One key factor behind this decline is the diminishing interest rate advantage that the dollar once held over other major currencies. As other central banks raise their rates or signal tighter monetary policy, the gap narrows, reducing the dollar's appeal to investors. Additionally, uncertainty surrounding leadership at the Federal Reserve has contributed to market unease. Questions about future policy direction and potential changes in leadership have led to increased volatility. Together, these dynamics have eroded confidence in the dollar, prompting investors to seek alternatives. Recent data reveals that U.S. manufacturing continues to contract, marking several consecutive months of decline. This ongoing downturn is reflected in key indicators such as reduced factory output and lower new order volumes. The persistent weakness in manufacturing suggests challenges for related industries, including transportation and logistics. As manufacturing is a significant driver of economic growth, its contraction may signal slower expansion for the broader economy. Businesses may respond by scaling back investments and hiring, potentially affecting employment rates. Analysts are closely monitoring these trends, as prolonged contraction could increase the risk of recession. The broader economic outlook remains uncertain, with policymakers considering measures to support recovery. Recent currency movements have seen both the euro and the British pound strengthen against the US dollar. This shift reflects changing investor sentiment and evolving economic conditions in Europe and the United Kingdom. A stronger euro and pound can impact global trade, making European exports more expensive while imports become relatively cheaper. For multinational companies, these fluctuations may affect earnings and financial planning. Additionally, currency appreciation can influence central bank policies and cross-border investment flows. As global markets adjust to these changes, investors closely monitor exchange rates for signs of broader economic trends and potential opportunities. Monetary policy is currently at the forefront of global financial discussions. Japan is considering a potential rate hike, a move that could signal a shift from its long-standing ultra-loose stance. Meanwhile, the Federal Reserve is widely expected to implement a rate cut, reflecting concerns about economic growth and inflation trends in the United States. These decisions are contributing to heightened volatility across currency markets as investors react to changing interest rate differentials. The interplay between currencies, bonds, and equities has become increasingly complex, with shifts in monetary policy driving rapid adjustments in asset prices. As central banks navigate these uncertain conditions, market participants remain vigilant, anticipating further changes that could reshape the investment landscape. As December approaches and we look ahead to early 2026, global financial markets are bracing for a period of heightened uncertainty. Central banks face critical decisions regarding interest rates, inflation control, and economic growth, each with far-reaching consequences. Investors are closely monitoring policy signals, weighing the risks and opportunities that may arise from potential shifts in monetary strategy. The interplay between tightening or loosening financial conditions will shape investment flows and market sentiment. With geopolitical tensions and evolving economic data adding complexity, the stakes for policymakers and market participants have rarely been higher. The choices made in the coming months could set the tone for global economic stability and growth well into the future. Japan's potential shift away from its long-standing ultra-easy monetary policy marks a significant turning point for global financial markets. If the Bank of Japan tightens its stance, it could influence currency dynamics, investment flows, and borrowing costs worldwide. At the same time, the U.S. Federal Reserve's confirmation of a rate cut signals a move toward more accommodative conditions in the world's largest economy. The interplay between these two major central banks may reshape investor strategies and impact economic growth across regions. Such changes could also affect inflation expectations and trade balances, prompting businesses and governments to reassess their financial planning. Ultimately, these developments highlight the interconnected nature of global monetary policy and underscore the importance of adaptability in an evolving economic landscape. Japan's economic decisions often send ripples across global markets, prompting swift reactions from investors and policymakers worldwide. This interconnectedness highlights how closely tied national economies have become in today's world. When Japan makes a move, whether it's a change in monetary policy or a shift in trade strategy, the effects are felt far beyond its borders. Staying informed about these developments is crucial for understanding broader market trends and anticipating potential impacts. By keeping a close watch on Japan's actions, individuals and businesses can better navigate the complexities of the global economy. As we wrap up, we want to express our sincere gratitude for your continued support and engagement. Your interest and feedback help us deliver content that matters and keeps us motivated to provide thoughtful analysis. Staying connected ensures you won't miss out on future updates and in-depth coverage of the topics that shape our world. We look forward to sharing more insights with you and appreciate having you as part of our community. Thank you for joining us today.